What's going on YouTube? In this video, we're going over Block, ticker symbol SQ. Over the course of 1 year or year to date, this company is down 27.7%. 1 year, this company is down 12.6%. Currently, this company is a negative has a negative EPS. Forward looking, it is positive. So we'll have to value this company a little bit differently than what we normally do. They offer a unified e-commerce ecosystem combining software, hardware, financial service, which provides sellers with all the tools they need for processing payments and growing their business. And here's some of their products that they offer to like smaller businesses and really any business that wants to use them. So very handy products to have as a small business. So we're here on the financials on this company, and right off the bat we can see we had some explosive growth in this company, and has hit a wall and is just flat for the last really probably year. Looks like it's starting to pick back up in the trailing 12 months. So this revenue looks like it's going to continue higher, which is good. Our gross profit, though, did not hit a wall. It continued to grow, which is awesome. However, net income did hit a wall and has since gone in the wrong direction, heading negative now. So they started hitting positive net income, and then since have rolled back over, cannot quite get above that threshold of zero and maintain it. So you have gross margin over here. I would say consistently about 35%. Net margin since has ran up nicely, but has leveled off around zero. Our growth rate on this company, revenue and gross profit, is somewhat declining. However, like we see up here, is probably looking like it's going to tick back up a little bit for growth, which is awesome. Return on invested capital, maintaining around a zero for that as well. Cash to debt, they do offer a little bit of some banking and other, obviously they constantly got money flowing in and out of the business in within the company. So this cash to debt is a little off because it is that type of a business. So we can look at over here on their balance sheet. Typically, when I look at these, I'll cross off these customer payables and settlement payables, which will give me a ST debt, roughly short-term debt of 2.3 billion. Our current cash, we're sitting at 5.9 billion, so we got plenty of cash to cover our short-term debt, so that's good. Same difference over here. We have total liabilities. We do have a lot more liabilities than cash, but we can take off about 5 billion roughly from total liabilities, which brings us down to about $8 billion. So we've only got about $2.2 billion more in liabilities than cash. So not too bad, but for the balance sheet side of things. Net income to free cash flow. So here's where we've got a lot more free cash flow. So we come up here, we have our net income, which we know is negative, right? We already went over that over here. You can see our net income is turning negative, and in the trailing 12 months is also continuing to run negative, but not as great. So we saw 553 million negative. Now we're at 278 trailing 12-month negative net income. Stock-based compensation on this company is massive. One thing I want to look through is the salaries on compensation for their employees, their executives over here. Jack Dorsey apparently does not take a paycheck, and these other four executives over here get paid very well. If we come back year over year for growth, if you just look at these numbers, you got 13, 8, 11, and 13. You got the same people here, 10, 7, 10, and 10. So they've all gotten a substantial pay raise in the last year and a couple years. So they're consistently getting a pretty sizable pay raise across the board here for a lot of these employees. And obviously there's an additional one in this one, but you can see that they're growing over there on stock-based compensation, which we can clearly see over here on our stock-based compensation. Obviously, what we're looking at here does not cover the $1.1 billion worth of stock-based compensation they are handing out. So that is a very, very, very big red flag. In the last really 2 years here, they've doubled their stock-based compensation. So that is a big red flag for any investor, which kind of tells us that they need the money to continue to proceed with running the business. But because they're doing that, that gives them a positive free cash flow. But we can see our share count is getting heavily diluted. Not too long ago in 2018, we were sitting at 400. Now we're at 600 million shares. Capital expenditures are pretty well controlled at this company. Did hit some sort of a big spike right there, but since has reduced, and now it's pretty nominal. I mean, this company is doing about $20 billion in total revenue and only have 147 million in capital expenditures. So Not too bad. So the overall financials in this company, it's kind of bleak. It's very they're producing $20 billion in revenue, but they're still not able to quite turn a profit. However, one thing we can look at is the income statement over here on their most recent earnings release. We've got our revenue. This is 6 months. We have $10.5 billion in total revenue, and we have all of our cost of revenues here, which I believe there's not really too much reduction that can be done. They're making money on pretty much everything except for hardware costs. So I don't see any way to reduce that side of things here. However, down here, product development is soaking up $1.3 billion every 6 months. Now, I don't want to see them reduce development and innovation, but maybe they can find a way to streamline it and make it not so expensive, potentially. Maybe they could find a way to reduce that. And if they can reduce that, and maybe cut it in half somehow without impacting the overall innovation growth that they have, then maybe that'll start turning a pretty good profit on this company. Over here, sales and marketing, that's another thing they could do is maybe reduce that a little bit. But again, the things that we're talking about reducing here, these two things are what grows the business. So it's like you don't want them to get rid of that, but at the same time, it's like if you do, then you can make a lot of money. So those are the two areas right there that cost them a lot of money. They've done a pretty decent job of keeping their SG&A in check. It is actually up 150 million, so maybe they could maybe trim off some fat at that company, that unnecessary labor that they have. So yeah, I mean, really, all they can really do is just cut back on their SG&A or their sales and administrative a little bit there, and really they could reduce these two a little bit as well. But that's what grows the business, so I'm not so sure that that's a good idea. So over here on the financials, that's what we just went over there is their operating expenses is just what's killing them over here. Revenues, the cost of revenues is just something that is just going to be what it is, I believe. So we have comps over here. We have four other companies to compare to. Over here on Square, we have several red flags. We have operating cash flow, which is higher than net income, which we already went over. Share count is getting diluted. Return on invested capital we know is basically flat to zero, actually negative right now. Pre-tax margin sitting negative as well. So quite a few red flags on Square. So we got our market cap over here. We see PayPal, Shopify. So Shopify is kind of a different animal of the group, but they do offer, I believe some sort of payment system. But PayPal we know is a more of a competitor. PayPal, and I believe ADYEY, I think it's called Aiden, but for Adine or something, I don't know, something like that. So we over here, revenue, gross profit, and income. We've got PayPal, the leader in revenue and gross profit and net income. So already PayPal is the leadership over here. PayPal's got tons of revenue and a much larger market cap. Growth rate. This one's kind of throwing everything off. We can see the growth rate over here on Square though is 38% EPS, 15% revenue growth rate. PayPal about equal to what Square is as well. Gross margin, it's not as good as everybody else, but they're up there. Cost of revs is what it is what it is. So operating margin, we can see just basically flat. Basically, they use up all their money on their operating margin, so then their profit margin is pretty minimal as well after they pay taxes. We can see that operating margin, a target for them would probably be in that 15% range. So they've got a long ways to go to get up to that 15% range. Free cash flow, Square, it's getting there, but it's doing it through stock-based compensation, so that's not something you want to see. Return on invested capital, same thing. It's an okay return on invested capital, but Square currently zero. PE, we are negative PE, but we can say PayPal's sits at 16 PE, which is pretty cheap. So you can kind of see where the competition is, about 16. Some of these other companies are a lot higher than that 40 range there. Calculator Peter Lynch valuation, Square. So again, this company does not have a positive EPS. So when we go through these valuations, what we're going to do is we're going to type in the forward-looking numbers and get a better understanding of what this company could be worth. So we got an EPS of 1.74 forward-looking and PE of, we'll call it 27. All right, so we type those numbers in. Peer Lynch valuation on this company, we have 1.74, PE ratio of 27 gives us a value of $61.22. Multiples comparison, we have to eliminate this company and Shopify because they're negative. That gives us a price per share of $47.57. Manual PE. Again, this is one of the this is like I would kind of consider this a banking company, so I'm not gonna include this into our valuation here. But based on what it is right now, it is very richly valued. Price to book on this company, 5-year average is 15.7, currently sitting at 1.5. So price to book, even just the ratio right now is actually pretty cheap. So PEG ratio currently sitting at 1.54. However, that is the forward-looking PEG ratio. So forward-looking PEG ratio sitting at 1.54, which is fairly valued. Graham's valuation, I'll give them a 1. We'll keep it at 1. Gives them an intrinsic value of $65.20 per share. Discounted cash flow. Analyst growth rate have 38.5%. I match their growth rate. They have an average growth rate of 10.68, 1,068%. You know, the growth rate over here, assuming analysts are correct, their growth rate has not been very consistent whatsoever. So I'm not so certain that this is a very good percentage to go by. You know, I'm gonna change that. I think that's a bit too rich on the percentage for growth rate. So I'm gonna go 20%. That gives them a discounted cash flow price per share of 9.63 or $9.63. Rule 72, we have our EPS, our current PE, which is actually our forward-looking PE, and 3 growth rate sources for an EPS. Average growth rate is 24.5%. So that goes into 72 3 times. That goes into 10 years, 3.4 times. So we get to double our EPS 3.4 times. So that puts us at 1, 2, 3, and a little over 4 there. So that'll put us actually at about, we'll give them about a 15 forward looking, oops, wrong cell, 15. So that's telling us it's worth about $183, about $184-ish per share fair market value on the Rule 72. So over here we have all of our valuations we just went over. Currently trading at $46.69 per share. Fair market value $73.52 is our fair market value. 30% margin safety $51.46. Analyst price target $82.73. So we're pretty close to where analysts are sitting, and right now we're trading below our 30% margin of safety, so not too bad. So real quick recap of what I think on the company overall is we need to see them start turning a profit, and they need to cut back on their stock-based compensation. Those are obviously a no-brainer, but should be 2 big key components to your business, to this business, before you invest into it. As an investor, your goal is to make money. And in order for you to make money, the company you're buying needs to also make money. And based on where the things are headed on this company right now, it doesn't look terrible, but it's something to be very skeptical with. I would be careful for sure. We'll look at the stock chart now and see how this is trading. So we have a very long-term support range around this about 40-ish dollars per share, $45 per share. That's been there for many, many years. So we can see it was resistance, resistance, broke through, support, support, support again, and since has been support many, many times here. Although it has broken through as of recently, but it's putting in a green candle to potentially push back above, which sometimes signals a bottom. So this could be, but although I didn't do it on volume, so that could be concerning that it might not, it might be a fake breakout back higher, but might continue lower. So the financials on the company is what I think is kind of pushing this company much lower. Obviously, the economic uncertainty with everything is probably another big catalyst. And once maybe the economy starts turning around, maybe Square will follow, and maybe revenues will start increasing as well, or not revenues, but net income will start increasing as well at this company. Technically speaking, here, I don't like that it broke through this support range it's held for many, many years. We're going all the way back to 2018 for a support range, and we've broken through it. So that is a bit of a concern for sure. And we are making lower highs as along with it. So not a lot of commitment behind this stock currently. This could be the bottom, but it might also not be. It could be just a fake break lower, fake break higher, and then resume lower as well. So I don't know. This one to me doesn't excite me personally. Maybe there is some catalyst, there's future catalyst for the company that makes this thing look very attractive valuation wise, but For me, I like to see a company prove itself. That's it for Square. If you found value in this video, drop a like, subscribe, comment, and we'll be back later in our stock analysis video.